Hi there, it's Geoff here. Pretty obvious what we have to cover today. Some of the economics and the fallout from the announcement by Trump of sweeping tariffs on imports. So here's the headlines in today's newspapers. The Guardian: Trump hits UK with 10% tariffs as US ignites a global trade war. The iPaper: Trump triggers $1 trillion global trade war in threat to UK jobs and wages. And at the Times: Trump piles on the tariffs. Now, there's going to be plenty of fallout, intense media coverage of this whole issue. It's worth following it. But I wanted to do today was think about the economics of tariffs, particularly for students taking their exams, and link it to some really important issues. Without doubt, it's the biggest trade policy shift from the United States in a century. It is going to cause huge potential disruption. It is a big external shock, both on demand and supply for the world economy. But let's wait and see how these things pan out, particularly if individual countries and regions and trade blocs try to negotiate changes to what's been announced recently. But here's the data. 10% minimum tariff for all countries on goods coming into the United States, including countries such as the United Kingdom, Singapore, Australia and Saudi Arabia. More importantly, there are significantly higher percentage import tariffs. The European Union, 20%. China, 54%, including earlier tariffs already pre-announced. And then Vietnam, Thailand and Cambodia. Interestingly there, the emerging Southeast Asian economies, heavily export dependent, emerging sort of manufacturing sectors, in particular in countries like Vietnam and Cambodia, have been hit with very high tariffs. We'll come back to that in a second. Taiwan, Canada and Mexico have already announced 25%. And there was a 25% import tariff on every foreign-made automobile. Now, it looks as if the tariff decisions have been made not on the basis of a complex algorithm, but on the basis of almost like a sliding scale based on the US's current trade deficit in goods with a particular country. Here's the data. I've just put 2 years there, 2015 on the right, 2024, the latest data I have. You can see the size of the scale of the trade deficits between, for example, the United States and China, hitting almost $300 billion, and the European Union. A large slice of which, by the way, of course, is accounted for by Germany and Ireland. But the United States runs huge trade deficits with Canada, with Japan, with South Korea, with India and other countries. So what are the main aims of these tariffs? Well, stripping away the geopolitics, and fundamentally there are three aims. One is to get the US trade deficit back to zero. That's a stated aim of policy. Import tariffs have been based, by and large, on the relative size of US trade gaps with countries. The second aim is to generate billions, well, Trump thinks trillions of US dollars in extra tax revenues that ultimately can be used to finance big tax cuts. It's a good example of increasing tax with the aim of cutting tax. And the third aim is jobs. The Trump administration is clearly hoping, perhaps expecting, that tariffs cause a switch back in manufacturing, a realignment of manufacturing in the world economy towards the US economy in sectors from cars in particular to textiles and from semiconductor chips to steel. So, reduced trade deficit, extra tax revenue, more jobs. That is the pretty standard playbook when you introduce import tariffs. To be clear, and I speak as somebody who's broadly speaking in favour of globalisation and comparative advantage and free movement of goods and services, people and capital, this announcement is fundamentally an inward-looking, nationalistic, protectionist trade policy. That it is what it is. It challenges the fundamental principles of free trade. And achieving all three aims, a lower trade gap, more tax revenue and more jobs, is almost impossible. It's almost like an unholy trinity. It does depend fundamentally on US consumers, millions of them, continuing to buy from those countries affected. Will they still buy textiles from Bangladesh? Will they still buy whiskey from Scotland? Will they still buy maple syrup from Canada? The tax revenues depend on consumers in the United States having a low price elasticity of demand for imports. Now, if you're taking an economics exam in the coming weeks and months, that is a really key point to understand. The United States, in truth, of course, has never been a major exporting nation. It's the biggest economy in the world, but look at this chart. Over the last 35 years, there's been a slight rise, recently a downward trend. This is US exports of goods and services over the last sort of 25 years as a share of GDP. Fundamentally, the United States only exports around 10% of its national output. So the United States has always been a relatively closed economy in that sense. Of course, it imports a higher percentage of GDP, hence the size of the trade gap. The fundamental question, I guess, is who pays these tariffs? Well, the answer is clear. A tariff is a tax, yes, and a tariff is paid for by the importer, not the exporter. Okay, so a tariff is an import tax. It's paid by the domestic company importing the goods, maple syrup from Canada, whatever it is, canned tuna from South Korea. Now, they may choose to pass on the cost to consumers, or they might choose to absorb some of the tax themselves, take a hit on their profits, and pass on a certain percentage to final consumers. There's also a third option, that exporters into the United States, for example, you might be exporting, bathrooms from the West Midlands to the United States, and you have a US importer and distributor. So the West Midlands bathroom manufacturer might come to an agreement with the importer, essentially to split or share the burden of the import tariff. I suspect there's lots of business finance directors having meetings with their distributors and importers today on that basis. So revenue will flow to the government. Tariffs do raise tax revenues, but of course the question is who eventually pays the tax. And the answer is the US consumer, because tariffs increase prices. This is something that Trump doesn't understand. He doesn't understand economics, obviously. But tariffs raise prices both for imports and, in theory, they're also going to raise prices for domestically supplied products. Because there's no immediate fix here in terms of the US having the supply side capacity to produce things more cheaply at a lower price than they can through imports. Let's quickly work through, if it's okay with you, the supply and demand analysis of a tariff. Super useful if you want to smash your exams. So let's take the market for cars, where the world supply price is perhaps below the US equilibrium price. In other words, other countries can produce cars a little bit more cheaply. And domestic demand is Q2, domestic supply is Q3, and obviously there's a gap met by imports. While a tariff increases the world price, the import price coming into the States, it has two main effects. First of all, it causes domestic demand to contract, so consumers will be less likely to buy cars if they're priced 10, 15, 25% higher price. Again, in theory, it encourages US-based car manufacturers to expand their supply from Q3 to Q5 because they can now get a better price per car. The profit motive, the incentive mechanism there is to expand production. Then the issue becomes, can they expand production? Do they have the capacity to do so? But the volume of imports decreases because now demand's gone down, domestic supply has expanded, so the volume of imports, quantity of imported cars goes down to Q5, Q4. So that's the trade deficit bit. And then, of course, there's the tax revenue, because the government gets the revenue for each car imported, equal to the vertical distance between those two supply curves. And the tariff revenue is shown there in the shaded area. So in theory, a tariff does reduce the volume of imports by increasing its price, and the government gets the tax revenue. There is also, though, of course, a consequence for welfare, consumer welfare. Now, if you're taking an exam, this is really important. So what I've done here is I've labelled all the various intersection points on the diagram, starting with A and working our way through to, I think, K. Okay? The shaded area is the tax revenue, but what about consumer welfare? Well, consumer surplus before the tariff was ALG, because we could import, or the United States could import cars at a low price. So before the tariff, consumer surplus was ALG. Now, consumers are paying a higher price. Price has gone up. So consumer surplus is ADF. So there's a loss of consumer surplus of FDLG. Now, some of that is tax revenue. Some of that is extra producer surplus for American car producers. But there is a deadweight welfare loss of IEJ and DKL. And that's the welfare loss because of the import tariff. So tariffs have distributional consequences, and higher prices, of course, are paid by consumers, many of whom will be on low incomes, who are least able to afford these higher prices. Will these tariffs cause higher inflation in the States? The answer is yes. Yes, they will. Economic theory says yes. The reality says yes, especially in the short term. Importers will likely pass on some or all the tariff to the final consumers. And this will increase prices for many, many thousands of products: imported cars, pharmaceuticals, food and drink, sportswear and sports shoes. But keep in mind also there are supply side effects. So tariffs on imported component parts, inputs such as aluminium or copper wiring, metals will lead to cost-push inflationary pressures within American industry. Most exports, of course, require imports. So if you're a US car manufacturer, that your costs will go up if you have to pay more for your imported steel. And US companies might need to shift suppliers or alter production processes due to these tariffs, potentially leading to inefficiencies that further drive up costs. So the likes of Nike and Adidas and lots of other brands based in Southeast Asia will be thinking, well, what are the consequences of these 45%, 50% tariffs for our costs? And then there's the wage price effect. As the cost of goods goes up, workers might demand higher wages to keep up with the cost of living. And that can cause further increases in prices. This is known to, of course, you'll know this as the wage price spiral. Tariffs are inflationary. There's no doubt about it. Okay. Now, there might be some deflationary forces if the dollar appreciates and if the world economy grows less quickly, world commodity prices might come down. So there could be some offsetting factors which help to bring down inflation. But fundamentally, tariffs increase inflation. So all eyes then turn to the Federal Reserve in terms of what they do with their main policy interest rates. How do they respond to this trade fiscal policy? And then looking forward, we're not going to see the effects maybe for a little while yet, but this will undoubtedly happen. Will there be big changes in the pattern of global supply chains? You know, this is the idea that your iPhone comes from over 100 different countries, that we readily import sportswear from Vietnam, from Turkey, from Cambodia. So, for example, a prolonged trade war will bring about shifts in global supply chains. Now, this is yet to be determined, but this will be a big shock to a fairly fragile global supply chain system post-pandemic. But those integrated deep supply chains around the world economy, part and parcel of globalization, they've deepened and extended across many decades. They are now under threat. Good example is Nike, great example to quote in your exam, heavily reliant on Vietnam as a production base. So will they absorb those higher costs or will they pass on higher prices? Just over half of the footwear and just under 30% of their leisure wear was produced in Vietnam in 2024. They'd moved to Vietnam away essentially from China. Adidas slightly less exposed, 39% and 18%. Other brands likewise. But keep a lookout for how these big, iconic, transnational leisure brands, how they decide to price after the tariffs, and do they make decisions about where they're going to manufacture. So much to think about. So I just try to take you through the economics of a tariff in this session. Clearly do follow the news. It is dominating the headlines. You've got other economic issues to think about as well. But this is something where you can really impress the examiners with your updated knowledge. Thanks for joining in. Stay happy, stay safe, stay curious, and see you sometime soon.